we don't have to wait till the company's worth 100 million to go, okay, now they've proven themselves. We're coming in at 5 million and that company is now worth 450 million.
It's the angel investing session. I would like to invite Amandeep, Hansara. Me and Amandeep, we sort of co-founded Medical Angels a number of years back. Dina, Tikova from UNSW founders, Rayn's from Archangels Ventures.
I had a passion for startups. I just got so excited about being around people who were innovating, who were trying to solve big problems in healthcare. And I just thought, how do I help these people? And one of the biggest challenges was really them having access to money.
In the world of healthcare, you know that 10 to 100K does not really move the needle when you really need to go through so many validations. So what we do, we tap into all the vast university networks, resources, expertise to make sure that those startups go from A to B with minimum capital investment required.
The secret weapon that we have is that when we're investing in healthcare, we kind of know a lot more about the likelihood of success of that company.
If we cannot return a 4x cash on cash return, you might as well buy some property.
For the next part, we're gonna have it's the angel investing session. So I would like to invite Amandeep, Hansara. Me and Amandeep, we sort of co-founded Medical Angels a number of years back, and and let's see it. And we get Dina, Tikova from UNSW founders. Now, this is a slightly different approach to angel investing because Dina sort of runs the portfolio at UNSW, and they run an accelerator program, and they also invest in sort of very early stage startups. And last but not least, so Rayn, come on up. And so Rayn's from Archangels Ventures, who a number of years ago, some of us have sort of syndicated investing in his fund. He, he's a very passionate angel investor himself before being a fund manager. Welcome. So this is really just a panel session, and I think before we start, let's just give the self intro. We're gonna start with you, Rayn.
Hi, I'm Rayn from Archangels Ventures. I have been an angel investor for 10 years, and we launched a fund called Archangels 3 years ago with Ben. Medical Angels, Amandeep and B has been a big supporter of Archangels. We raised 40 million, and then Man Angel is one of our biggest kind of syndicated investor in the fund. The fund is early investor in Heidi Health, which I think Ben will touch on a little bit. I actually have their hat on today, so I'm gonna represent it for the photo shoot.
That's a new logo.
Yeah. That's a short intro.
Yeah, you can say a bit more than that.
I guess.
What do you love about angel investing? Yeah.
Angel experience.
I guess I'm here because I was one of the only people that got onto the AFR Young Rich list just by angel investing. So I think that's a pretty good achievement. Don't ask me where I rank. Rank last, actually.
Yeah. And how many angel investments have you?
So privately, personally, about 100, and then we have close to 50 or 60 in the fund now.
Yeah.
The way we approach angel investing is we do a small investment across many companies, and as they deliver the outcome and progress, we go a medium-sized investment and then large investment. So in terms of Heidi Health, for example, we have invested 4 times. 10% of our fund is currently invested in Heidi. For the Medical Angels member that invested in the fund, I think we'll do quite well. I believe we'll do quite well. Yeah.
All right. Now, Dina.
Yes, Dina, Tikova from UNSW founders. Back in 2019, I launched Health to Next program out of University of New South Wales in partnership with the Georgia Institute for Global Health, because we saw an opportunity that hardly anyone in Australia were backing evidence-based, research-based, clinician-led ventures. Because back to Ed's presentation, it always falls into this hard to understand, hard to back, too complex type of investments. And at UNSW, we do have a capacity, resources, and infrastructure and networks to de-risk those ventures, and that's what we have been doing. So as of today, we have done 40 investments into a variety of companies across digital health, basically everything from heart assist device, which is the most tricky one to develop, regulate, and test, all the way to digital health and mental health. And you'll see a lot of our portfolio companies like Devotion and Amelia Bar just pitching in the next session. And it's, of course, I guess I'm here because we worked very closely with MedAngel since 2023. I was trying to count how many joint investments we have, and I think I counted 12. All the way getting back to evidently in 23 strands and stuff. So 12 out of 40, 12 investments has been done with MedAngels, and we do hope to do much more in the future. And maybe just to give an example, because regulated heart stuff, clinician-led, so how the de-risking looks like in my world at UNSW Founders. One example can be a company called Neuroflux. And maybe one more point that is very distinct about what I do. We see ventures long before those people know they have venture, because we sit on campus and sometimes we start engaging with researchers 3-5 years prior they would even incorporate, and we will guide them toward this incorporation. And we have more and more those spin-outs coming our way. So maybe one example.
No, don't jump ahead.
Huh?
Don't jump ahead.
Oh my gosh.
That's part of the next part of the questions.
So the risking is the next part.
Yeah.
I'll pass to Amandeep.
Yeah.
Okay, that's all right. I've got one. Thank you.
Amandeep.
So I'm Amandeep. I'm a GP by background, as in Dr. GP. GP also means another thing in the venture world. So I realized that when I'd introduce myself in venture meetings as a GP, and they're like, "You're a general partner of what fund?" So I met B, I don't know, 5-6 years ago, and I had a passion for startups. I had been working in the corporate sector, mostly in corporate, but then had started working with some startups and done a couple of startups in the telehealth space myself, and didn't even know what a startup was when I was, in my early part of my career. But then when I figured out what it was, just got so excited about being around people who were innovating, who were trying to solve big problems in healthcare. And I just thought, how do I help these people? And one of the biggest challenges was really them having access to money. And many of them would, do the family friends round and then kind of get stuck, because obviously your family happy to put money in whatever you're doing and says it's a good idea. It's not always a good idea to listen to your family, but they would put money in, and then they go to venture capital next. And venture capital, as Ed had said before, were like, we'll invest in everything except health, too risky. And so when I met up with B, I was like, how do we get money into these companies? Because I think there's a really great opportunity here. And he's like, well, I have a bunch of people I know who have money. So we ended up joining forces, and that was sort of the birth of Medical Angels. And it's been an incredible journey, because what started off as a Facebook group, it's still a Facebook group, but has become a lot more sophisticated thanks to Ed and his platform, where me and B were just thinking what trusting strangers these are who are meeting us on Facebook and transferring money into our bank accounts. And so thank you all for trusting us. But we're now the second largest, investor by number of companies in the health tech space in Australia. So I think it's only Artesian that's done more health investments than us. And to think just the two of us as our side job have managed to help facilitate all of that capital to go into what I see as the future of healthcare is super exciting. And whoever asked the Canva question, I did get access to Canva secondaries. So I just want to say, if you hang around, and it was just purely by hanging around with people, you meet someone who knows someone, and they're like, hey, guess what? There's an opportunity to invest. So I've now diversified outside of healthcare. I spent a year working for Main Sequence Ventures, which is a venture fund partly owned by CSIRO. So the government puts money in, but we also had a lot of other LPs, limited partners who put money in. And I had a great experience learning how venture works at the big end of town. They had about $1 billion under management. But just through knowing people, you then get access to deals. And I was going to hope you would say something about Canva too, because you're probably the person to know if anyone's looking for Canva deals. But yeah, you jump on it when you see something. And that was obviously oversubscribed. It was literally a few weeks ago. And it was oversubscribed. And they had to pick and choose who actually got access to the deal. And it would be the same with Heidi and other sort of darling companies that we have coming out of Australia. So that's sort of been my investing journey. I have a day job as well, working for the Australian Digital Health Agency, which is also great because I get to understand what's coming up with regulation, what's coming up, in terms of government priorities, what's coming up in funding opportunities, and about to embark on a whole process now of how we regulate AI in healthcare. And it's great to be sitting in that position and then also look at what companies are doing and say, well, that's where I put my money in because I know that's coming down the line. So yeah, that's me.
Lots of hats.
We can find about it later.
All right. So I guess one of the questions I get, why does the ecosystem need people like us? I think it's a bit, why do you think you're needed in this space, and what do you really do best, I guess, Rayn?
I think we have an abundance of Series A in Australia. And by Series A, I mean when the company is doing, $1 to $3 million revenue, the business model has been quite figured out. They just need extra, capital to scale faster, or maybe even expand to other region. Where we see a really big gap is between the family and friends round and then the Series A round. There's a big chasm that you have to cross, maybe to get the product to the market, to get the unit economics right, or get the marketing or sales channels more mature. Usually this process takes 18 months, maybe half to 1 million extra after the friends and family round. There's a big gap. Everybody say they are a pre-seed investor in Australia, and wait till you get them to write the check. And not that many people actually write the $500K to $1 million round. And then we're quite lucky to be able to partner with a few.
Can you just explain what pre-seed and Series A mean?
So there are lots of different naming mechanisms for the different rounds. There's friends and family, pre-seed, angel, pre-A, a bridging round, and it gets really confusing. So internally at our firm, we go round 1, round 2, and round 3. So we are active in the round 1. And then there could be a round 0.5, which is the friends and family, usually quite small, for someone to, get a few things together, buy a domain name, whatever. So you can, kind of understand it that way. All right. By round 2, things are quite figured out, right? You have some revenue. There's not enough player in round 1.
So is Series A your round 2 or round 3?
Now let's throw away the Series and stuff. Second round, so there could be a bridge in between. Yeah, there's or sometimes there's just a little bit more information required, and then you do a bridge. So yeah.
Okay. All right. Dina, why does the world need someone like you?
So we're a university, right? So we don't have billions under management to invest. So our investment, the money part is quite tiny. It's literally between $10,000 to 100 at very, very max. That's what we can do for health and medtech startups. And in the world of healthcare, that 10 to 100K does not really move the needle when you really need to go through so many validations. So what we do, we tap into UNSW and affiliated institutes infrastructure, talent, and networks to pull a lot of in-kind resourcing to make sure that those startups go from A to B, not rounds, but with minimal capital investment required. So at that point, they are perceived as de-risked by the majority of investors in Australia. So how does it work? Just one example that I mentioned earlier, company NeuroFlux. Sam, who is the founder, his PhD was around monitoring the blood flow to understand if the person will be having secondary stroke. And it's a very lightweight wearable device where you can complement basically CT scanning and nurse observation and save a lot of costs and, of course, people's lives. So imagine a PhD student coming with world-leading research and being quoted $900,000 to develop the prototype that needs to be used in a clinical study that will cost $500K more. So his prototype was entirely prototyped in our own maker space with the support of the prototyping engineers and industrial designers. So that was $900K saved. His clinical studies and clinical validation, we have connected him to Professor Craig Anderson, who is the world-leading stroke researcher at the Georgia Institute for Global Health. He fell in love with the solution because he sees those patients on a regular basis. He basically helped to design the whole study, attracted grant funding. They are finalizing their clinical effectiveness study across RPA, Prince of Wales, and St. Vincent's as we speak. And now, only now, after 3 years, opening the seed round where they will be calling for other investors. So they went all this way just because of all in-kind support UNSW provided through our affiliates and networks, which otherwise would absolutely be dead, not existing, and he would have some kind of a job and not doing his startup. So that's an example of why players like us are essential, because we are there as connecting tissue to all the vast university networks, resources, expertise, from prototyping to clinical validation to our alumni or global networks, and help de-risk those companies to some certain extent. So that's does it answer the question?
Yeah, of course.
Well, obviously the world needs us. That's why we're all here. I think, and B always says this, is we kind of have this secret weapon. I think when you invest in a company at a very early stage, and it might be companies worth, $5 million or even less, if you're a general investor and you don't really understand that sector, it's a huge risk to put your money into an idea that could, 9 out of 10 companies statistically fail. So what do you know that someone else doesn't know that means that you're going to win at choosing the best companies? And I think somebody asked that question, like, how do you choose? I think the secret weapon that we have, and all of you have in the room, is that when we're investing in healthcare, we kind of know a lot more about the likelihood of success of that company. And it's been incredible when B and I have watched what other investors have put money into and gone, wow, we know that's not going to go anywhere, because there are things that we understand about the health system, whether it's the behavior of doctors, whether it's financing, whether it's regulatory processes. We know things won't get through. And so for us, when we pick something really early stage, having the intel, the expertise of everyone, in our network means that we're actually making more sure bets at a very early stage. So we don't have to wait till the company's worth 100 million to go, okay, now they've proven themselves, we can come in. If we're coming in at 5 million, and that company is now worth, 450 million, won't say what company that is, but you want to put your hat back on. So, we then go, well, we kind of knew that was going to be a problem that needs to be solved in healthcare. So I think it's having that sort of almost like secret knowledge that we have of things that are really going to succeed in our environment. But it's not only just knowing, but then it's also actually being able to help. So I think that's the real key. Is like you put the check in, but it's not stopping at the check. So what you also have the ability to do as an investor is you could be a user, right? You automatically could become a customer. You could also then talk to your peers and say, hey, there's this product I've invested in. Do you want to use it, in your practice? You could also be head of a department at a hospital where you go, well, let's do a pilot here. And you could be the key that unlocks that company's success. And I wouldn't underestimate the power of one individual who has some influence in actually making a company really successful. And we've done this, like B and I have done this, nothing great, but, just introduce them to the right person, or got them a meeting with, someone who runs a hospital, or, put an ad out to all of you to say, hey, this is a great product. And so I think it's the ability to influence. And if you didn't actually work in this sector, it's much harder to influence. But because you are all potential users and you are the people that are going to help shape and advise the company, and we've had companies that we have worked with where we've said, actually don't go in that direction. Use what you've got to actually build something over here, because this is where the problem needs to be solved. And they've listened to us and then succeeded. So I think that's the exciting part, is actually having influence. And you don't get to do that with a lot of your other investments. With this one, you actually get to be hands-on if you want to be. Otherwise, you can just sit back and wait for it to, do its thing. But I just say, if you are going to invest in this space, see it as an opportunity to do something fun as well. It's not just a gamble. It's actually, you can influence it.
Can I add to that? So this reminded me of a conversation with a very successful e-commerce, brand operator, and he said to me, if I invested in some of the tech stack that I use when I discovered them, I would probably make more money than my e-commerce business. And then what he meant was like he discovered Shopify to host, his website, and then Stripe to process the payment, HubSpot to run the marketing, and then third-party logistic, Afterpay for the buy now, pay later. So he discovered that because he was a user of those, and then he actually looked around for the other solution, and then finally went with that particular one. So like what Amandeep has said, because you're from this industry, you probably know better. And then if he then back to the angel investing team, it's like if he discovered that HubSpot probably weren't listed, right? If they find a way to get into the secondary rounds or the angel rounds, he would have done super well, including local Afterpay, which is a local company.
Well, I hope that's our GXE story, Ed. We're using you. We're like, might as well invest in you. And I hope that that's the Shopify story for us.
I actually prepared a few talking points, and then but when I look at Ed's presentation, he actually covered most of it. So I'm like, okay, that's great. Which is why we are very happy that we actually invested in GXE too. So yeah.
Just to touch on what Amandeep was saying, people who are experts in some fields sometimes underestimate how much value they can add to startups who operate in that field. Not all our health startups whom we support are clinician-led. Very often it is engineer-led, it is industry professional-led, or some other type of expertise. And any insights coming from clinicians sets those startups to completely different direction. So specifically, if you see that it's engineer-led or someone who is not clinician-led type of startups, you can always sometimes offer just a quick coffee chat or Zoom, and that can set them for the right direction as well.
Excellent. We've got some time for any other words you want to... I actually want to ask you, Rayn, one thing. Amandeep and Dina both talked about very sort of deep tech, but I guess you're seen more as a generalist investor because your fund invests in a lot of things. What's your experience there, and also investing in some of the stuff that requires a bit more, I guess, deeper knowledge?
Yeah, so we are a generalist fund, meaning we can invest across all the different industry and verticals. But then that also means no one can be an expert in all the industry and verticals. So I'm happy to report that Ben, myself, Amandeep, and B, we have a WhatsApp group. Whenever we see a health related deal, we try to get their input, and then we do that with all the different sectors, right? But then the essence of our investment approach is that when we can see a strong return of investment for the customer, like if you pay me $100 per month, but you get $1,000 worth of value, whether it's more revenue, time saved, that usually is enough for us to take a proper look. And often we can invest a small amount before the product is built and before revenue has been booked. Then, we get the companies to that level where it unlocks the next pool of investor. So back to the question of what value do we bring? We bridge them with the money to get there, but we also open the doors with the introduction. So they raise the 1, 2, 3 million, to continue to develop that business opportunity.
Yeah, it's a very different game, isn't it? The different sectors that we play in. All right. I think we'll try and do some Q&As. It's probably the best. I'm sure there's lots of questions in the room.
Hi, my question is to Rayn. How does the cash out work with your company? So like if someone invests with you, how does the timeline typically works? Or do you just buy the shares, their part from it, and just sell to someone like one of your other investors, or how does that work?
So the thing with this industry is the casualty will happen first. The company fail first, and then you have some small outcome that get acquired. A small exit event, but usually the biggest one, usually take more than 7 or 8 years. So then, as a fund manager, we have to manage the whole, investing, nurturing, support, and then the exit. So because we are one round earlier than most funds, you have to be a little bit more patient with us. So we have to wait the extra 1 year. So I would say, we set the expectation upfront to the investor in the fund is that if we get a big outcome, it will be towards the tail end of the life cycle of the fund. We don't want people to call us every quarter, hey, where is my money? Because this is just not the asset class for it. You can do private credit for more predictable yield. Where people will kind of allocate to venture is, I have this is say 100% of my money. I'll allocate 5-10% into various venture, and then I'll wait 7 to 8 years. Maybe they'll hit a Canva, maybe they'll hit a Heidi, which we have both company shares in the new fund because we have one company that was acquired by Canva, and we have Canva shares in the fund.
Thanks for that. Just if someone was to start out in this space, where should we start? And generally, how much do you need? What's the minimum amount that you need to invest to actually start in this space?
So Dina actually run an education program called Angel Investor Program. Is that still running?
Thinking about it.
Yeah. Okay. So we used to run it in terms of education for people that are new to investing. What kind of check size? How do I approach it? How do I run a portfolio? There are some good content online as well. There are a few other programs similar to this. That's probably the best place to start. Yeah.
Yeah, I did a course with StartMate. Are we allowed to talk about StartMate? Okay. I just don't know who's sponsoring. Anyway, so StartMate, they're owned by Blackbird, which is the large VC fund. So they run what they call First Believers, which is kind of like an angel investing course, which Rayn teaches on.
That's how we met.
That's how we met. Okay. So I did that. So that's if you're really serious about it. But you start with as little as $5,000. You don't have to have a lot of money. It's hard for you to directly put $5,000 into a startup because a startup does not want to have 100 people with $5,000. So that's why the syndicates are good. And while obviously I'm going to promote Australian Medical Angels as the best syndicate to join, there are lots of other syndicates. So there's like Sydney Angels, Aussie Angels. There's a lot of other angel syndicates that you can just look up and you can join the syndicate. And that way you can put in small amounts, but you can invest in lots of other sectors as well. Like we mostly do health, but occasionally we'll do a bit of fintech. But you'll find that I've invested in some ag tech. Like I love the agriculture space and I love what they're doing in technology in that space. So I've joined some syndicates around that. And so you get, it's really interesting when you get a bit outside of healthcare as well. I'm not an expert, but I know that the syndicate themselves have done a bit of due diligence, a bit like what we've done in picking the companies they think are worth investing in. But I'd say also, like if you find somebody doing some research at a university that you're like, that's going to be a really great spin out, go to them and say, can I invest? That's another way.
And even lighter touch, if you think about, again, just being exposed to those early stage ventures and maybe have few mentor meetings or stuff, you start developing your own kind of taste or gut feel of who performs how, what type of founders are driving the business. You'll start seeing patterns. So if I understand all doctors it's a very busy profession, but if you can also expose yourself just to interaction with startups, through whatever capacity. Sometimes it's honestly just 30-minute Zoom call. You start developing your own a bit of one-liner. What do you want to invest and how and what type of founders and how you can support not.
This is directed to Rayn and Amandeep. Sorry, Dina. What's the biggest challenge that you had in trying to understand this space when you guys got into it, and the challenges of understanding venture capital and angel investing when you first got into it?
It's actually quite easy. You just, put the money in, and then you wait, right? And then next year you realize, oh my God, what have I done, right? So, like as long as so I was quite lucky. The first few people that I met, they are really experienced venture manager. So someone told me you need to do, at least 20 similar size investment over 4 or 5 years, because that's how you capture a cycle, right? If you put everything at the top of the market, like 2021, congratulations, right? Like, no, actually, no congratulations. So then if you go 2021, you buy some, all the way for the next 4 years, you would probably have a pretty good entry. And then he also said, reserve half your money for the best looking one that comes out from, the 4 years. Go double down on that, right? So I typically do a 25K direct, and then I'll do 10 of those a year, so 250K outlay. Of that 10 companies, 2 will go really, really well next year. I'll do 50K into this, right? The idea is then when I lose 25K. When I win on 75K. So buy low, sell high, lose small, win big. And that's probably the easy approach framework that we try to teach at the investor course.
Yeah, I think initially for me, it was overexcitement. You'll see somebody pitch to you and you get kind of swept up in their enthusiasm and you're like, yes, it's a great, and you trust everything that they say. And I think, as Ed was there laughing, sorry. I think initially I did the same thing where I got overexcited and I was like, yeah, I'll just double down and put all my money on this. And then I realized the whole, like, there will be, for every company that you see, there'll be 50 others that you'll get excited by. And so you have to just pace yourself. And I'd say exactly that, like small bets on multiple companies, because you just don't, and you've got time to watch them, because, the growth is kind of like, a bit slower because it's health and they might have to go through various, stages, but you can watch them and say, hey, I think they're doing something really great here. I'll put a bit more in, or I'll put a bit more in. And usually they're quite flexible, because as we heard before, the series A, B, C things out of the window, because they'll just have different points where they'll want more money. I think also don't be afraid to get to know somebody over a period of time. Like we've had companies that we've been friends with for 2 years, and B does a lot of coaching with them, and then he gets to a point where he's like, okay, now they're ready to accept money. So I wouldn't have put money into them at the beginning, but now I've gotten to know them. And you could just have a regular monthly like coffee with someone and say, how's the company going? And then over time you go, I feel confident now to put money in. There's very few situations where you're going to miss out on something. I understand we talked about Canva and Heidi. There are a few of those, but most of them, it's not like you have to decide in a few weeks. You're going to have time. So I just say go slow, small bets, and really challenge what they're presenting to you, because some of the stuff that they present in pitch decks are not always the truth. Just be wary.
Yeah, maybe I'll add to that. I think my first ever angel check was $200,000, and I realized I didn't have that many $200,000 to play around with. Thankfully, that company went well. But the whole idea after that, I was just like, oh, we need to probably go slow a bit.
I just watched your check size.
Yeah, because I'm running out of money. Any other questions? Yeah.
Thanks, guys. Thanks for your time. Listen, just a simple question probably for you guys. Like, say we're investing 10 or 20K into one of your firms, and you invest that into maybe 4 or 5 startups or something. And say you are going to exit one of those startups, and then you have to distribute, right, the profits or something. Do you do it that way, or do you just say, we give the capital and you leave it for 5-10 years and then you talk about it? How does it work?
So to answer your question, when we get a distribution, when we get an exit, we usually have to do the distribution. But just to clarify, as a fund, the minimum investment into the fund for us is 200,000, but it's not one go. probably 50,000 per year over 4 years. As we make the investment, we'll make the capital call. And then if someone want to come in for a smaller amount, then you have to talk to Amandeep and B, because that's how they syndicated, many doctors and specialists, to join the fund as one investor. And in terms of the number of companies, we are probably approaching 60 companies. So we do the spread, we met with thousands of companies and then we pick 60. And then when they start to make progress like Heidi, we go concentrate, right? So that's the value that the manager brings. It's like, you don't want to do 10 coffee a day, right? I like to drink coffee, so let me do that for you. But then we also support them, or whiskey. So if you follow my content on LinkedIn, you know why Dina said whiskey. And then, as they make progress, we read the updates, we concentrate more money into the future rounds. So that's also part of the job of a good manager. But when we get the exit, we distribute it. And if we do more than one time, we take the 20% carry, as Ed has mentioned earlier.
So just to clarify, there's two different sort of mechanisms we're talking about. So one is investing in a fund, and the fund decides who are the companies they're going to invest in. And so obviously they'll have exits at different points, and you're actually exposed to all of the companies that they're investing in. And then the other thing is the angel investing, where you're investing directly into a company. So obviously when that company exits, you get that return back. And so just to clarify, there's and obviously you're going to talk about venture capital in the next session. Oh, private equity, yeah. Yeah, okay. So there's a few different ways that you get that back. But as Rayn said, for you to get access to invest into venture capital funds, you often can't do that with just $5,000. You would need to be part of a group, like say Medical Angels. Then we pull it together and we say to Rayn, we meet your minimum amount of 200,000, and then we can invest as a group. So it's a way to get access to venture capital that you wouldn't normally get. And it's just going to be similar discussion with private equity too. You would not normally get access to being able to be a direct investor into these. Angel investments a bit different. You could probably do that, but just for people, because I know there's different levels of knowledge about this space.
So this is a question for Rayn, and just I guess to give an idea of I don't know. So when you guys did the Archangel fund a couple of years ago through Med Angels, what is the value of that fund now compared to where it started? Just to give an idea of what has happened through.
So initially we were thinking about just the partnership. We're investing about 4 million of our own money. And then we just need to raise 6 more million so that we can register as an ESVCLP, which is tax-free. And then we went to market with the announcement and we go to 40 million. So the demand was pretty high. As we talked about earlier, the casualty will happen first. So what happened with the net asset value of a venture fund? It goes down to 80 cents on the dollar because of the casualty and the fees. And then the up round starts to happen and then it comes out. Then it looks like a J, right? The alphabet J. So the J curve of VC. So we are 3 years old. Normally at 3 years old, you're probably at around $1 or 90 cents. We are at about 1.3. Yeah, no, that's the number guy. This is the marketing guy. But does that answer your question?
Sort of, because you guys have a portfolio and obviously have a projected runway. So in, at say the 10-year mark where you think the fund will close, where do you think you'll be?
Well, it's really hard to predict, right? But if the company continue to perform, so we probably have about 7 or 8 company that have crossed 1 million revenue, that 3 or 4 that cross 5. Yeah, obviously Heidi is way higher. And on aggregation, as they start to raise their next round, then we get the uplift. So that's a leading indicator towards that. But in terms of industry benchmark, if we cannot return a 4x cash on cash return, you might as well buy some property, right? So I think we talked about property and ETN yesterday. Yeah, this is the alternative allocation, which is more high octane.
Yeah, and just to add to that, it's the the accounting valuation only happens at a future price round. So sometimes they might have had a growth, but they've not had a round yet. So there's no valuation, so you don't actually mark it up yet.
Yeah, can I just make a point around that? If a company does not need to raise but are doing really well, it doesn't look great on the numbers because you actually don't know what they're valuing at, but they're actually doing so great that you don't need to go back and price themselves. So it's really literally sitting on your hands and waiting, as Rayn said. And then, yeah, you see, you just go and look up sort of, some of the exits that people have had from previous funds, say the big funds in Australia, whether it's Blackbird or Atrium, and that's what you aim for. So you'll be able to do a bit of that online.
Like when we look at our portfolio, most of our investments down there safe, which actually even doesn't have sometimes a valuation cap. And then it will see that that's say simple agreement for future equity. So basically it's like a loan to the company where you don't have equity or shares. And then when we do our kind of review of what's our portfolio worth, all those safe holders, we just put like 1.5 million. And then some of the companies who are generating revenue don't need to raise and convert to equity. They just sit at 1.5. I'm just looking at Catherine, who'll be pitching, because she's too busy selling. She doesn't really rating. She's just going and growing through revenue. But we only will realize what's the value of the company grows when it is converted or raised as well. So hence, I'm not sure if you do safes, but that's our challenge. When we value our portfolio, it is a lot of those 1.5, so there is not 1.5.
Yeah, and I think we can always ask Manzuru how all the accounting standards for startups are, but then we need to probably have half an hour for that because it's a very complex area. Yeah. Yeah, and so any last words?
Not last word, but
Final words.
I would like to throw in a special offer because of your support. Like, it's a vast, topic to cover. We don't have enough time to cover everything. But before you write your first angel investment, ping me on LinkedIn and use the code FECO25. I'll have a free 30-minute chat with you. But make sure you type Rayn on, not Ryan on. I changed my name to dominate SEO.
Is a marketer.
Look, we worked with Medical Angels for 3 years now. We will continue to do more of this. We're also diversifying within our portfolio, going both more deep, back in more deep tech ventures, and also specializing in women's health investment, where we believe that's the next huge opportunity and unmet potential. So if you're also into women's health investments, talk to me.
And I'll just do a plug for Medical Angels. So as B mentioned, we're about to start our own fund, just more because we've realized there's so many great companies out there that we want to invest in and we want to move faster, and it takes a while to syndicate. So we are interested in obviously people that want to join us on that journey. So there's an EOI form and that'll all be happening very soon. If you also want to get involved, like more hands-on, then please give us a shout out. Like if you want us to introduce you to companies that you want to meet that are already in our portfolio, so we've got over 30 companies that we already have invested in. If any of them are of interest that you want to talk to them, they're always looking for clinical input, they're always looking for advisors, and it's a way sometimes to get in and then start doing a bit of work with them and, potentially also invest. So feel free to reach out to one of us if you want to get interested in actually being more hands-on, because I think that's where the fun part is. The money's one side of it, but I actually just really love working with these companies, and you'll get to see some of them pitch soon. Thanks, B.
Thank you very much.
Thank you.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial investment or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.